Ladies and gentlemen, good morning and welcome to the Syrma SGS Q3FY25 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks, Ryan. On behalf of ICICI Securities, we welcome you all to Q3FY25 results conference call of Syrma SGS Technology. We have with us today senior management, and now I hand over the call to Mr. Nikhil Gupta, Head of Investor Relations, to introduce the management and take the call forward. Thanks, and over to you, Nikhil.
Thank you, Aniruddha. Hi, a very good morning to all. Welcome to Syrma SGS Q3 and 9 months fiscal year 2025 earnings call. We have with us today Mr. Jayesh Gujral, Managing Director, Mr. Jayesh Doshi, Director, Mr. Satendra Singh, Chief Executive Officer, and Mr. Vijay Agrawal, Chief Financial Officer, Syrma SGS, to discuss the performance of the company during the third quarter and 9 months 2025, followed by a detailed question and answer session. Kindly note, during this call, certain statements that will be made are forward-looking, which involve certain risks, uncertainties, assumptions, and other factors that can cause results to differ materially from those in such forward-looking statements. All forward-looking statements made herein are based on the information presently available to the management, and the company does not undertake to update any forward-looking statements that may be made during this call. In this regard, please do review the disclaimer statement in the earnings release and all other factors that can cause a difference. With this, I will now hand over the call to Mr. Jayesh Gujral, Managing Director, Syrma SGS. Thank you. Over to you.
Hi. Good morning. A warm welcome to everyone to the Q3 FY24-25 earnings call of Syrma SGS Technology Limited. The quarter gone by has been a satisfying quarter, and the 9 months have also been satisfying, which is reflected in the performance of the company. Revenues for the quarter were at about 892 crores, which represented a 24% year-on-year growth, and for 9 months they were at 2,900 crores, growth of about 40%. What is more satisfying, apart from the revenue growth, is that the steps taken by the management to bring back the margin profile of the company has started yielding results. For the 9 months FY25, our EBITDA, operating EBITDA margin stands at 7.2% against a guidance of 7% given at the start of the year. For the quarter, notably, this stands at 9.1%. But this gives us the confidence that 7% achievement would be possible, and if any movement, it will be only north of 7% in the coming quarters. PBT also has shown a healthy growth of 37% for 9 months and 144% for 3 months. Exports stand at about 20%. Exports have had a subdued muted scenario because over geographies which we are servicing are essentially America and Europe. And in Europe, it's primarily Germany. And Germany is today the sick baby of EU. It has the highest delinquencies per month. So we have had a muted growth, but the turnaround is visible from the orders and the indications which we have received for the next year, that is FY25-26, I think will rebound back, though it will be a painful and a long journey. It is not going to be a one-quarter recalibration to the original levels. MedTech business also has been a bit slow because of push out by some customers and delay in the development of the products, which we are very confident that in Q1 of next year, it will bounce back to whatever we had envisaged when we had taken over the MedTech business of Johri Digital, which is now known as Syrma Johri MedTech Devices Limited. On an overall basis, we are confident that we would continue to grow at the industry plus average with the margins which we have guided, that is a min EBITDA margin of 7%. We hold that guidance for this year, and when we come out with the final results for FY25, we'll come out with the guidance for the next year. As of date, we are on track to achieve the guided EBITDA in percentage and absolute numbers, what we had said of 305, 310, something of that range for the current year. And next year, we expect a growth of about 30-35% with corresponding increase in the EBITDA margins. We have onboarded some good automotive and industrial clients in the current quarter. And going forward, which will be 26-27, we expect significant business from these clients. In 25-26, these clients will be yielding sub 200 crores of revenues. With this, I hand over to Bijay Agarwal to take you through with the detailed figures. Thank you.
Thank you, Mr. Bijay. Good morning, everyone. I will now take you through our brief of financial performance for the quarter and 9 months ending December 2022. On a consolidated basis, my total revenue from operations for the 9 months is about 208,062 crores. That grew by almost 41% on year-on-year basis. And for the quarter, it is 869 crores, which is with a growth of 23% year-on-year basis. During the 9 months, the robust growth is broadly based on, I think, across multiple industry levels, largely contributed by industrial work segment, consumer segment, and primarily in the IT segment here. Similarly, for the quarter, we had a strong overall growth in the auto industrial sector again. Our export revenue for the quarter is 210 crore rupees, which is approximately 25% of my total operating revenue for the quarter. And for the 9 months, it is about 583 crores. Our OEM revenue for the quarter is about 13%, and for the 9 months, it is approximately 11.5%. This quarter, we had a strong rebound in the margins, led by expansion in gross margins on the back of change in business mix. Consumer sector business is slightly lower than other segments here. The gross margin for the 9 months is 21.3%, and for the quarter, it is with a very healthy gross margin of about 26.7%. Broadly, 200 bits of expansion on a quarter-on-quarter basis. Our operating EBITDA for the quarter stood at about 79 crores with a year-on-year growth of 88% and an operating EBITDA margin of approximately 9.1%. For the 9 months, it is around 208 crores, growing 53% year-on-year basis. Similarly, PBT for the quarter is 66 crores, again with a growth of 144% year-on-year. And for the 9 months, it is 146 crores broadly. PAT for the quarter is 53%, again approximately 6% of a PAT margin. And for the 9 months, it is around 113 crores. Coming to our open order book visibility as on date, as on December 2024, it is around 5,300 crores, which comprises almost 30% plus of our contribution from auto segment, about 38 to 40% from consumer segment, approximately 22% from industrial segment, and balance from healthcare plus IT and railway segment business. On the working capital side, currently, as on quarter end, we stood at around 64 days of net working capital based investments. Again, it is slightly higher than the last quarter. We continue to make efforts to keep this net working capital below 60 days on a sustainable basis. Moving to our debt position, we have a gross debt of approximately 685 crores, against which we are maintaining a treasury of 412 crore rupees, and with that, my net debt position is 273 crore rupees. Out of this total debt, this is primarily funded through the working capital, and only 65 crore is what is the term loan here. Coming to my capex, for this 9 months, we had spent approximately 180 crores of capex, and largely towards building up this new campus facility in Pune and a facility there in Germany. Some bit of additional capex towards some SMT line and plant and machinery stuffing for new customers onboarding. asset turn for the quarter is about 5.5 times, and ROC for the quarter is around 13% on adjusted basis. We expect this to improve further as we work on higher utilization of our CapEx going forward. Slight bit of update on the merger side. We are waiting for the final order from the NCLT, and we hope we should be able to complete this merger in another 3 to 6 months of time. We expect this full year, as we have guided broadly previously also, we expect this full year we should be able to close at around 300+ crores of overall EBITDA for the full year FY25. With this, I will hand it over to Satyendra Singh, our CEO. Thank you very much.
Thanks, Vijay. Good morning, everyone. I think Gujralji and Vijay covered the numbers pretty well. I'd like to start with the comment, which is to thank all my colleagues in the company who have worked hard to execute the strategy, which we have been kind of sharing with you and executing every day. So thanks to the colleagues, I think we have had this very, very good quarter. To repeat a little bit about this strategy, I think we continue to build for future, which is to focus on the people, to focus on the processes, and to focus on the plant capabilities. And Pune, which was opened in October, is one such investment which we have made to build our capability and also to fill in the white space which we have had as a company, because we were not present in the western region. So that kind of takes care of our ability to fulfill the customer needs in the region. Overall, I think we are executing day in and day out on the operational side. So there's a lot of initiatives which we have done to streamline and improve our processes on the process excellence side. So with this, I think I'll say thank you everyone once again, and back to Nikhil to take the questions and answers.
Yeah, thank you, Satyendra. The operator requests you to please take us to the Q&A session.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Dhananjay Bagrodia from Ask Investment Managers Limited. Please go ahead.
Hello, sir. Just wanted to ask you regarding your debt position. Debt has increased year on year. So how should one look at that going ahead, and how are we thinking about this?
So year-on-year basis, debt has increased slightly bit, primarily basis the working capital investment. In this quarter, we had additional working capital towards some bit of new additional inventories bringing in related to new customers on board. That will keep on select within this quarter, these aberrations may come. But on the full year basis, we have already guided that we will bring down this overall working capital investment below 60 days. That's what we are confident we will be able to maintain on a sustainable basis.
So the 60-day working capital, that is sacrosanct.
Yes, that's there. As on this quarter in December, and we are at 64 days of net working capital investment, but gradually on quarter-on-quarter basis, this can again come down below 60 days. And again, it's a dynamic number. When the business is growing, revenue is growing, overall working capital investment, it may increase depending upon the business. That's how the overall working capital borrowing is also linked with that working capital investment.
And last quarter, we also commissioned our Pune plant, which is yet to give revenues, but the inventory builds up happens when you start up a new plant and you bring in new customers. The prototyping and all that takes time, but the inventory goes up. And hence, we have seen a marginal increase of about 4-5 days in working capital, net working capital, which we believe that we're very confident that in the coming quarter, by the end of this year, we should be sitting at about 60 days of net working capital. And this is all working capital, and there is no sort of long-term loan on this.
Gradually, this is reducing.
And these, in terms of order book, what would be the order book for this quarter, and how much do we see that executing over the next 18 to 24 months?
See, Vijay will go into the details. Orders, we normally track it on an annualized basis. As I've all the time been saying, we are mindful of quarter on quarter, but what we are very focused on is what is the long-term story. Is it intact, growing, or is it having some issues? So we don't, figures are available, but we don't track orders on quarter-to-quarter basis, because in one quarter, a new customer comes, he gives a 200 crore order, it will show a bump. On an annualized basis, we have a very solid order book, which Vijay will deal with in detail.
During this quarter, we got decent orders intake.
Sorry?
Please go ahead.
No, I think the order book, how long are you seeing that being executed over?
So this is getting executed over a period of 9 to 15 months. The current order book, which is 5,300 crores.
5,300 crores. Sure. And so lastly, most of our businesses, excluding industrial, have Q-on-Q been flat. Is there any seasonality in these businesses in terms of auto, consumer, and you mentioned healthcare, but auto and consumer, is there any seasonality in the businesses?
See, on quarter-on-quarter, it could have bumps because each industry has its own, dynamics. For example, the auto industry or the consumer industry where we are not present, typically stocks up for Diwali in Q2 of the financial year. And the dealer and the sale happen in Q3. But at the production end, the manufacturing and the uptake happens in Q2. So this over a period of time gets neutralized, and we are on track to achieve the growth rate in the respective verticals which we have set out to.
So thank you so much. Congratulations again for a good set of numbers.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, we request you to restrict to one question per participant. The next question comes from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Good morning, gentlemen, and congratulations for the very strong performance in this quarter. So my question is on, the margin profile, that improvement that we have seen. Is it at, if I see your order book composition, I think auto and consumer continues to be almost 60 to 70% of your order backlog. So is it that incremental orders that you all are taking are at a better margin, or what would we really attribute to the margin improvement over here?
See, the margin improvement, as I've all the time been saying, is a function of the product mix which we sell. For example, in Q3, my consumer business is only 31%. High volume consumer business, which is a tight margin business, whereas my industrial business is 30% for 3 months, against an average of 25% for 9 months. My automotive is 24% of my revenue for this quarter comes from automotive. For 9 months, it is 21%. So the product mix change results in this change in the margin profile. And as I had said earlier, that for this year, we are targeted about 40% of our revenue coming in from consumer business. The wish and the desire of the management, on which we are working with a very focused strategy, is to bring this high volume business to about 35% of our revenue. I would be happy with 30%. But I don't see it happening immediately. If it comes down to 35, it will have a natural positive impact on the margins. Vijay?
Additionally, the operating efficiencies which we have been working upon since last maybe almost 2 years, both on the supply chain side and maybe operating scale side, both have been at least now delivering on the result side.
Okay. So this is basically product mix. It is not that the incremental orders that you all are taking are, or you all are getting are at a slightly better margin. It is basically the product mix that is driving really the efficiency over here.
Every industry has its own margin profile, and every customer has its margin profile. We always endeavor and strive to increase that margin profile within the industry. For example, if an automotive customer gives me a 22% gross margin, our endeavor is to take it to 24% with some customers, 28% with some customers, so that the blended margin comes down to is about 23, 24, 22. So it's a mix of vertical-wise the sales And then the endeavor of the management that new businesses which we take in the upcoming fields, in EV and all that, they should be at a better margin.
So when we say this is business mix, in that business mix, this is automatically getting covered that higher margin business and now we are adding much more in the profile.
Sure. Thank you very much.
Thank you. The next question comes from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi. Thank you for the opportunity. I have two questions. First, what exactly is happening in the consumer segment? Because we have had this 38-40% of the order book as consumer last quarter as well, but growth over has been tapering. So is it more like by choice or there are some execution issues? What exactly should we read through over there?
There are no execution issues, abnormal execution issues. The normal execution issues are running in a factory, or they're always there. What we have done in the last quarter is that we have started renegotiating prices for the high volume consumer business to see whether we can have a bump in some margins or not. And that is a long-term strategy of the company to move to the high profit, high margin business, low, medium volume, high margin business. Consumer business will continue to be about a high volume consumer business will continue to be about 1/3 of my revenue. That's the desire. And that is also guided by the PLI. See, we have a limit on the PLI, so there is no point of bumping up the business which is not with PLI.
So we are structuring the business in a way so that we can maximize on the PLI side, on the benefit side, and additionally then improving the overall margins either through pricing, and that is where we are at least this business on a deliberate side we are keeping as a check here. So we should be keeping it as a balanced number in the overall profile also.
Understood, sir. A follow-up on that, does low margin also mean low ROCE or asset turns are better so that the ROCEs are offset in the consumer segment? And secondly, is consumer largely exports?
See, typically in the industry, in the EMS industry, a high margin business will have a low asset turn, higher working capital involvement. You can't have all the positives or all the negatives in one. So a low margin business has a comparatively significant lower working capital involvement and a higher asset turn. So this is the typical nature of the industry.
And in this, on this question of the export side, this is largely domestic business. So maybe almost as of now, this consumer segment business about 80-85% is domestic and balance is export.
Sure. Thank you. I have more questions. I'll join back.
Thank you. The next question comes from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
Thank you for the opportunity and congratulations on a great set of numbers. So my question will be regarding, firstly, could you reiterate what is your guidance for FY25 and also you mentioned for FY26? Sorry, I joined the call a bit late. And secondly, what is the kind of steady margin that we should expect, considering, and we do appreciate that every quarter will have its own product mix changes and every segment will have its own margins?
See, for the FY25, we had guided a 7% EBITDA, which comes to about 3,305, 310 or something around that, or north of 300. And we are confident that we'll be able to achieve that in this quarter and for the year. Now, FY26, we believe and we are confident that we lower than the industry rate, and the industry growth rate is typically 30-35% currently. And if we grow at 30-35%, then there'll be a corresponding bump in my overall EBITDA margin also, when the operational leverages kick in and all those things. So we are on track to achieve what we had guided for FY26 early on, that this is a wish list. Now we are on track for achieving that.
Great, sir. So, and secondly, a very important point is that for the last 2 quarters, we have been showing considerable improvement in our EBITDA margin. This is the second consecutive quarter. So has anything structurally changed in terms of whether we are targeting certain sub-segments within the key segments, or how should we look at it? Or probably it is finally boils down to the function of our product mix change, which could be transitory.
It could be a product mix. See, in Q1, we had 54% high margin consumer business, and that hit us badly on the margins. In Q2, this came down to about 40-odd%, and we've sort of bumped up to 8-odd% EBITDA margin. This quarter, it is down to 31%, so the EBITDA margins go up. So EBITDA margins are a clear play of the product mix and operational efficiencies kicking in. The endeavor of the management on a long-term basis is to bring down the high volume consumer business, which is inherently low margin, to below 35. 35 is the bare thing. I would be happy if it can come down to 31, 32, 33 and grow over other business. The efforts of nurturing clients over the last 2 years in other sectors like industrial, like automotive, have started yielding results. And in industrial, we have got some very formidable names in various applications. For reasons of confidentiality, I will not be able to take the names, but they are with superior margins and reasonably decent revenues.
Understood, sir. Very clear. And also, is exports a driver of our margins in any way? Is it a higher margin business as compared to...
Export is a higher margin business. Unfortunately, for the current year, we are only at 20%, so we're down from 25%, because of slowdown in Germany. Germany is today a sick baby of EU, and Trump has just come in. I think it will be a while before the policies get settled down. So, but on a long-term basis, again, I said we are worried about quarter-on-quarter, short-term. On a long-term basis, we are very focused that exports should constitute north of 25, possibly 30% of my revenues. Now, whether it is 25 or 26, that I really can't say, because it's a play of domestic business also panning out in various segments other than the consumer. But yes, exports are comparatively higher margin business, and we intend to bring it back on track to about 25% of the revenue, which currently has come down to about 20%.
Understood. Very clear, sir. All the best, and thank you so much.
Thank you.
Thank you. The next question comes from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. I just wanted to understand on the new the new entity that we have formed for laptops. What sort of revenue potential can we see from this new venture that we are getting into? And maybe just on revenue guidance, wanted to check if the 4,100 crore guidance still stands, or is that number sort of, revised down with a higher EBITDA margin?
Okay. What I could understand is about the laptop business, and the guidance which we are giving of 30-35%, does it include laptop, or laptop will be in addition to that? Is this your question?
No. So the laptop business revenue potential and the 4,500 crore revenue guidance that we have given for this year, does it still hold?
Okay. The laptop business has just started last month. It's still in the infancy stage. It will mature in the coming quarters, and in the coming year, it would also mature into going up to the backward integration of board level assembly. Currently, it's a laptop assembly. On the guidance of revenue, we are more focused on the margins, and we are very confident that whether we do 4,200, 4,100 or whatever, the 300 plus 305 crores of EBITDA margins are intact. Revenue is a play of consumer business, other businesses. So to us, based on the inputs of the street, we are more focused on growing as per the industry rate with margins of 7% or 7% plus.
Sure, sir. Maybe just wanted to check if any PLI incentive is booked this quarter, and is there any one-off income because the other income is relatively higher? Just wanted to check these two items.
One-off income, we had acquired a piece of land for expansion in North once we put up the campus in Pune, we felt all expansions should happen in the Pune campus. So we sold off that piece of land in Haryana, Manesar, and that has resulted in a one-off income which is shown separately and not in the operational EBITDA.
Sure, sir. Any PLI this quarter?
About 15 to 17 crore rupees of total income for the full year. PLI.
Sure. Okay. Thank you, sir. Best of luck for future quarters.
Thank you. The next question comes from the line of Bharat Shah from Ask Investment Managers Limited. Please go ahead.
Yeah. Namaste, Gujral Sahab.
Namaskar.
Gujral Sahab, this I'm actually asking Vijay. You have referred to EBITDA margin of 7%, but I suppose what you mean is operating profit margin of 7%, because EBITDA margin will mean operating profit plus other income.
Operating EBITDA margin of 7%.
Yes.
Sorry?
Without treasury income.
This is operating EBITDA margin which we are referring 7% plus.
विजय आपका आवाज नहीं सुनाई दिया.
I am saying this is operating EBITDA margin which we are referring 77% plus, and other income will be over and above that.
Because he kept saying EBITDA, therefore I just wanted to clear the confusion, because that what he means is operating profit margin of 7%. Okay.
Yes, please.
And the outlook for the year coming, we were earlier discussing turnover of closer to 6,000 crore or thereabouts. So is that something intact?
I think we would come back with that figure, but with the current estimates, I think there could be a marginal variation in that, but with a caveat. The EBITDA margins which we had guided based on 6,000 crores of revenue would be intact.
Okay. So which means it will be a play on the overall profits. Turnover will be a resultant number.
Yes, absolutely. So we say that, okay, if you are guiding the street for X EBITDA margin, absolute figure, then that X can be constituted by 100 revenue or 120 revenue based on the product mix. But to us, it is the X which we are guiding the market. That is more important.
Absolutely. Last bit, on the capital efficiency, return on capital employed, what is the progress being made? One element you highlighted, that working capital will be sought to be kept below 60 days, and hopefully it will improve further going ahead. New facilities have been built, new hiring and talent investment has happened. So physical infrastructure, people infrastructure, other initiatives all are in place. Therefore, hopefully with the growth of the business, should it result in a measurable improvement in return on capital employed?
That's right. That's what we are also targeting. My overhead costs are much more stable now, and the expansions are largely been taken care of. So with this, the way we are anticipating next quarter also, we are targeting like this year we should be closing around 14.5 to 15% of ROC, and gradually it should then move towards our targeted ROC of 20% over the next 2 years.
So by fiscal 27, we should be hugging closer to 18 to 20% return on capital employed.
Yes.
Okay. Thank you and all the best.
Thank you. The next question comes from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Thank you. So just to clarify, as you mentioned that, revenue may vary and the margin may vary, so you're targeting for absolute EBITDA. So in that backdrop, how should we think about, say, gross block asset turn or is there any other measure, say, EBITDA per 100 crore gross block? Whichever way, basically, how should we think of that measure of ROCE?
So currently, we are at a weighted average asset turn of around 5.6 times. With this increase in scale, we are hoping we should be around somewhere around 6 times of asset turn. And that is where we are saying this year probably we may much more closer towards 14.5 to 15, and gradually then this should improve thereafter.
So annual between 5 to 6 asset turn is sustainable, and or I would say more optimum asset turn that is possible, and targeting EBITDA margin, operating EBITDA margin of 7.5%. Is it correct?
Yes, gradually, yes, operating margin will again we see an improvement in the operating margins there, or maybe asset turn should improve either thereafter 6 to 7 times in that case. That's the play between revenue and profitability.
And as you discussed that share of consumer should or would come down, that should impact theoretically negative to your gross block asset turn, and that should be offset by higher margins. That is how it will play out, or just want to understand the construct of the ROCE with the mix change.
If we say this 35% or maybe less than 35% of consumer business, that is actually not a negative growth. There will be a growth and positive, but other businesses may grow at a better pace, so that overall in the overall total portfolio, this business should be within that check of 35%. That's what we are saying. So asset turn side, I still don't see a negative from 6 to below 6 that way. Gradually it should improve further, the increase in scale. And as my Pune facility also ramps up, this will also add to my asset turns going forward.
Okay. Last follow-up. So based on current gross block, what is the maximum revenue that we can generate? Ballpark?
With the product mix, which we have said about 35-37% consumer and all that, we should be able to achieve 6,500 crores of 6,500 crores of revenue with this gross block, with marginal additions for balancing equipment and all that.
Okay. Understood. Noted, sir. Thanks a lot and all the best.
Thank you. The next question comes from the line of Bhumika Nair from DAM Capital. Please go ahead.
Good morning, sir, and congratulations on a good set of numbers. So just wanted to understand how JDHL has performed in the quarter and for the 9 months. If you can share revenues, EBITDA and PAT and the outlook for the same. And my second question is on the auto and the industrial segment. We've seen order backlog growing quarter on quarter, but I guess I'm not too sure if I got the number right, but you said that industrial was about 20-25% of the total order book. So if you can just give some outlook on industrial, what are the new segments, what orders we've seen, because it seems a little lower than our historical trend.
So I can explain the medtech business, and then maybe Gujral can add on the industrial piece side. Medtech business is slightly subdued in this quarter, which we have already explained at the start of this call, that we are expecting this to rebound from next quarter onwards, or maybe this current quarter onwards that way. So as of now, in the last quarter, this business has done approximately 20-25 crores of revenue with a less than 10 crores of EBITDA, around 10 crores of EBITDA that way. And going forward, we see this should rebound better on the quarterly basis.
See, on the medtech business, we are building the platform, and there has been a slight a delay in customer lifting, customer approvals and all those things. But we are very confident that in the coming year, so we are delayed, push out by about 9 months, but in the coming year, financial fiscal 26, I think medtech should come back to what we had envisaged, and thereafter, beyond 26, it should grow because the customer, the designing and the products and the areas which we have entered in the last 1 year, we have recalibrated the entire business in the medtech space so that we are now more outbound, more customer-centric, rather than executing businesses which were historically coming in. So more outbound and customer-centric than inbound business. I still believe and I maintain that in the coming years, medtech business should be a very reasonable, decent chunk of our business. Currently, it's at about 6%. Now, if we grow at 35% and this business also grows at 6%, it has a natural growth, but I expect it to grow at a faster rate in the coming year.
So, what is the current, where do you expect, what is the order book out here? And, when you're saying 26, 27, you'll see a significant ramp up, what kind of revenues are we looking at from this business?
I would not be able to share the revenues, to be very honest, but the pipeline, the product development pipeline, which we are today catering to, including designing, which would go into production in the coming years, I think gives us the confidence that in the year 25-26, we should be closer to maybe 160, 150, 170 or 200. But it's a bit early because it also involves designing. It's not a pure play manufacturing of a product which has already been developed.
In the order book also, this healthcare business in totality is contributing almost 7.5% of my total order.
Okay. The second part was on the industrial business, if you can throw some light on how the order intake has moved and what is the outlook in terms of new client additions, etc. And which segments are we seeing growth being driven by?
Our current order book on the industrial side is about 20-22% of my total thing. On the subsector side, we see a lot of traction on the smart metering business side mainly, and we have added one more new customer recently, and previously, as we have explained, Honeywell business is also now picking up gradually. So we see this subsegment will perform much better on the industrial side. Additionally, we are working on the renewable piece, which is kind of a solar segment here in this case, and maybe other power supplies business, which will contribute to this particular segment.
Just to add on to what Vijay and Gujralji covered on industrial, it's a combination of Indian business as well as exports business. So in exports, I think we see we have a couple of customers which we would not be able to share the names at this point, but we have the business logged in, and that should start trickling in the FY25-26. So we would see a growth over there from those customers.
And just to delve on the applications within the industrial segment, utility metering, including smart metering, whether for gas, electricity or water, is one dominant component. Power supplies and power management units for data centers is another dominant segment. Industrial cleaning, wet dry steam is a decent sized business. Then we have into the renewable like solar trackers or solar inverters, which is developing, which I think in the coming years should go up. And then it would be like automation, communication cards, automation cards. We've got I can't think the name of decent, very good order from a global giant for interface cards. And this goes in a very, very high volume.
Got it, sir. I have more questions. I'll come back in the question queue. Thank you and all the best.
Thank you. The next question comes from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah. Sir, two questions. One, what is the total PLI benefit that we would have booked in 9 months? And also, in a way, is the money received or is it accounted for? That is question number one. And secondly, we have seen now back-to-back slowdown in the consumer business. So how do you see the outlook from over next 2 odd years? And also, as I understand, generally the Q4 is quite heavy from a RAC perspective, and Q1, Q2 are strong because of demand for water purifiers. So Q4 and Q1, we should see a higher revenue share of consumer business. Is that understanding correct also? Yeah, thanks.
See, on the business part, the consumer business, which is not high volume, is going as per track. And that's a high margin business. It's not a low margin business, though it's clubbed in the consumer segment. And for this quarter and the coming quarter, we are on track to grow as per the industry rate with the margins which we had guided. Again, end of the day, it is a focus of the management to give margins and see that the margins consistently over a period of time inch upwards. So with that in mind, you have a flexibility to play with the product mix without sort of sacrificing the margins and still doing the business. As I said, we are renegotiating some of the prices to see what incremental margins we can get. So that's a work in progress. On the PLI, I think Vijay will take that one.
PLI for the full year, we are estimating it should be around 15 to 17 crore rupees. For the 9 months for current financial year, we have accrued around 14 crore rupees.
Okay, and what was the number last year, 9 months?
Last year also full year number, I don't have a 9-month number that way, but last year also for FY24, this number was around 16.5 crore rupees. Full year basis, FY24.
Okay, sure. Yeah, that's helpful. Thank you.
Thank you. The next question comes from the line of Aditya from Investec. Please go ahead.
Hello. Hi, good morning, sir. So my question again is on the PLI scheme. I remember in one of the earlier conference calls, you had indicated that there's a PLI benefit due of almost 45 crore rupees in respect of FY24, of which our share would be around 16 crore rupees. So just want to clarify these numbers that we are saying. Is this our share which we retain and which we kind of record as income in our books of accounts, or it's the total quantum that we've received in 9 months?
This is a net basis, like whatever we probably may need to share. So this is these numbers which we are quoting are all net basis, which should be our share retention.
Okay, so 14 crores that we've received in 9 months of the fiscal is roughly our share.
Yes.
Correct.
For current financial year.
Understood, sir. And this will be in respect of entirely FY24, correct?
This will be in respect of current financial year. Current financial year, what we are saying, it will be around 17 odd crore rupees, of which 9-month number will be around 14 crore rupees on a net basis.
And we record it on a cash receipt basis, or we are doing it on an accrual basis?
We are doing it on accrual basis.
Understood. Because last year, sir, wasn't it a case that we thought of doing it on a cash receipt basis, and therefore we weren't really recording a lot of PLI benefits, and we had spoken about PLI benefits coming into the books of accounts in the following year?
So that is something previously in the initial start of the very first year we were in effective the time we were getting the first approval there. So which we changed, then later on it is now concurrently on all approvals.
So the first year is always a tough year when the entire application has to be vetted by the department and the agency is nominated by it. So that takes a lot of time, and hence we were conservative to not account for it. Once the products are approved, the capex is approved, then it's only our data which generates the sort of how much sales and how much is the PLI. So it's a very simple methodology, and hence, as per the industry practice, we have migrated to accrual basis.
Fair point, sir. So does that mean that in one particular year we would have recorded on cash basis PLI benefits which was meant for the preceding year, as well as on the accrual we would have recorded the benefits of the same year?
Yes. Previously it was on cash basis, so we changed it previously then to accrual basis. Now it is currently on accrual basis. So there is a change in practice.
Sure. So this year, 14 crores is in respect of current year accrual, but we would have recorded on for cash for preceding year also, right? So overall PLI benefit that we would have recorded would have been higher. There would be some amount for FY24 as well.
So for previous years, it is all linked to whenever we get it, so that's how it is slightly different that way. For current year related, we have accrued around 14 crore rupees.
Sorry, your voice was cracking a little.
So I'm saying previous year related, it is linked to the receiving of the cash, but currently, for current year related, we have accrued around 14 crore rupees.
No, that's a fair point, sir. I'm just requesting for one simple data. 14 crores is in respect of this year. Have have we recorded any amount in respect of preceding year, FY24 as well, which we may have recorded on cash basis?
Preceding year related, it is linked to the receiving of the amount, which will happen gradually.
Understood, sir. Thank you.
Thank you. The next question comes from the line of Sumant Kumar from Motilal Oswal Financial Services Limited. Please go ahead.
Hi. Can you talk about the railway order inflow and also what are the sub-segments we got ordered for railway?
Railways?
Yes.
Railways, I think we had guided that this year we'll be doing about 70 crores of revenue from the railways, and we are on track to achieve that revenue this year. New product approvals are in pipeline, so till those product approvals by RDSO happen, because every product has to be approved by RDSO, it will be tough to give a figure, but I believe that next year this figure should be higher than 70 crores. Even if it's a 50% growth rate, it will be about 100 crores. So anything between 100 or 100 plus crores in railways in FY26 is what we are targeting.
Which are the sub-segment in railway, sir?
Sorry?
Which are the sub-segment in railway, the product type?
These are there's many. They are brake controllers. The bulk of it will be signaling equipment and other products which go onto the wagon. But bulk of it would be the signaling system for the railways.
Okay.
So it will be a mix, 50% what goes onto the locomotive or what goes onto the wagon, and 50% what goes onto the infrastructure, which is the signaling.
Okay. Thank you. Thank you so much.
Thank you. The next question comes from the line of Bharat Shah from Ask Investment Managers Limited. Please go ahead.
Gujarat sir, earlier you mentioned that big turnover from the current infrastructure can be around 6,500 crores, which means virtually before the next year ends, we will need to raise physical infrastructure to prepare for the growth ahead.
See, we have this facility in Pune where the equipment can be plugged in. We have just got 2 lines in Pune and it has capacity to take in a number of more lines. And then, yes, for 26-27 onwards, we will be constructing within the same campus a production facility to taking us for the 26, 27, 27, 28, because there will always be an overlap. But the bulk of the cost is the land which has already been acquired, the building and all that cost, but it's not comparable to what the land cost is.
So which means if we need to raise the capacity, we can do it fairly quickly.
See, currently for the 9 months, my capacity utilization is around 70% or little less than 70%. So if I have done 3,000 or 2,900 crores of revenue at 70%, this takes us to 4,000 crores, and the new sets which have just put in, which are not taken into the capacity, would yield additional results. The Pune facility has just been set up. So we don't count that into the capacity because it takes time for us to build the output from a new plant. You have to get customer approvals, you have to get quality approvals. But with this base, with some marginal balancing equipment, 6,500 crores is achievable, and this would also depend upon the product profile. Hypothetically, if I was to do only consumer, then it could be even more than 7,000. But with a low volume, high mix, all those things, the blended output should be about 6,000 to 6,500.
So basically, as we get into the next year, at some stage, we will have to unlock new capacity to prepare for 26, 27. So basically what you are saying is that can be done reasonably quickly at Pune facility to raise the overall production capacity.
You are right. You are right. it takes about 6 months to set up since it's not a vertical growth, it's a single-story growth in Pune, it takes about 6 months to set up a manufacturing facility. And by the same time, you order the equipment, and you can sort of align the receipt of the equipment with the completion of construction.
Sure. And Vijay, just one issue. For the current year, what is the likely tax rate for the profits?
This is approximately 23 to 25% there. For the quarter, it is lower because there is other income which attracts a lower capital gains tax, and that's where it is lower. Otherwise, it will be around 23 to 25% currently.
And the next year would be presumably be similar?
Yes.
Okay. Thank you.
Thank you. The next question comes from the line of Praveen Sahai from Prabhudas Lilladher Capital. Please go ahead.
Yeah, hi sir. Can you give the capex number for 25 and 26?
So current till 9 months, I have already spent around 180 odd crore rupees. In this quarter, I may spend somewhere around 30 to 50. So current year, it will be around 200 to 225. And next year, I may spend around 100 to 150 crore rupees.
Okay. And also, in the past, you had announced for the QIP. What's the status for that?
We have the approval from the board and shareholders together. As of now, we have not initiated anything on that thing. We are internally working on few of the expansion growth projects. If we need any further additional capital, then we'll probably go for that.
Okay. Thank you, sir. All the best.
Thank you. The next question comes from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah. Hello, sir. Thank you for the opportunity. So, if we understand, our progress as a company over the last 2-3 year period since we went public. So, does it mean that our strategy as a company is now more focused on EBITDA margin, the way you mentioned about, you renegotiating the contracts, going back to the customer, versus the kind of growth we were talking about and chasing growth? The working capital had expanded, and that's why we also thought of doing a fundraising, and now we are talking more on the margin front. So what has led to this change in this thought process over the last 2 years? You saw things changing on the on the customer side, demand front, competition front. If you could help us understand on this part, number one. And number two, going forward, in the order book, consumer is still high, but your industrial order book is also increasing. So does the increasing pie of industrial and others, which is railway IT, also benefit your margin? And will we now consistently be looking at, on an annual basis, 7% plus kind of EBITDA margin without other income? These are my two questions.
See, we have recalibrated our sort of strategy based on the inputs and the growth areas available, which I had earlier also said it was not that we were sacrificing the high margin business for the sake of low margin business, and that continues even today. We are more focused on generating EBITDAs, and that's the recalibration we have done. Why we have done it? It's because of the inputs we have received from various quarters. And correction is always, I think, welcome thing if it's for the better. We continue to sort of focus on margins with growth at the industry level. Now, on your other question of railways and others, those businesses are factored into our normal plans which we share. And I'm very confident that going forward, what we had guided for this year and next year, will be able to achieve that.
Okay. And for this sustainable 20% ROCE, so what sort of margins would it require? 7.5, because the way asset turns will change depending on the product. So what sort of margins are we looking at for that sustainable 20% ROCE number?
Vijay?
So I think if we are able to improve the overall asset turn somewhere between 6.5 to 7 times with a overall EBITDA margin of 8%, I guess we'll be nearing towards our targeted ROC.
And also better working capital management and control.
Okay, so 6.5 to 7 times asset turn with a almost 8% EBITDA margin. Now, this is possible when we go for what sort of product mix in this then, because the margins are also higher, assets are also higher than the historical.
When we talk about margin percentage, that already factors in the different product mix here. So whichever product mix comes, if we are able to deliver that EBITDA margin with a lower working capital investments, so automatically the ROCs will improve it.
Okay. Okay. Thank you. Thank you. Good luck.
Thank you. The next question comes from the line of Vipra Srivastava from Phillip Capital. Please go ahead.
Hi, I'm audible, right?
Yeah.
Yes.
Yeah. So quickly on the PLI thing, which one previous participant asked. So in FY24, it was cash based. In FY25, it's accrual based. Is this correct or am I wrong?
The current year accrual, only FY23 was cash basis, then gradually we have changed the practice.
So 24-25 both were accrual based, right?
Right, yes.
Okay, thank you. And secondly, so quickly on the consumer segment. So you had, if I remember correctly, you were saying 40% should be from consumers. So if you take 9 months and if you take the revenue mix for 9 months, we already are on 40%. So in Q4, should we see the same mix of business or do we see consumer going up in Q4?
I personally don't see consumer significantly changing in Q4. At the end of the year, I think will be around 40%, maybe a percentage lower or half a percentage higher, maybe 38%, 39% consumer business. The endeavor of the management, as I all the time been saying, is that to bring it down to 35%.
Right, sir. And so lastly, I mean, we do know that in the electronics ecosystem, Government of India is coming up with a PLI on components where they're going to incentivize the component, let's say like bare board. So do we see some risk on that end? Because if your peers backward integrate into bare boards in your consumer segment, how do you plan to compete with them?
See, on the backward integration, I have been dealing with it all these quarters. So the backward integration essentially would be into either the PCB manufacturing or the semicon manufacturing.
Right.
And in PCB manufacturing and semicon manufacturing, they are independent business units, business projects to be evaluated on an independent basis. Now, hypothetically, if I set up a PCB plant, will it give me a positive rub on my EMS business? The answer is no. I manufacture 700, 800 type of SKUs of all types. There is no way I can manufacture the entire thing in my factory. So maybe some critical boards I manufacture in the factory, but I'll continue to outsource PCBs from the PCB vendors. Today also we have got a dozen PCB vendors for each category, seeing the cost and the capability. So these projects are to be evaluated as stand-alone projects. It gives you a de-risking of business, fair enough, but there is a downside if the EMS business goes down. Who will use the semicon components which I make? It's the EMS which is the major consumer of the semicon component. Who will buy the PCBs which I make if the EMS business goes down? So it is to be evaluated as such. Nothing negative, nothing positive. It has to be evaluated on a stand-alone basis. If it fits the parameters which the management has set, jolly well go ahead for it. But it has no significant leg up to my EMS business.
Sure, sir. But sir, I mean, one of your large peer, they have been saying that they will consume the entire PCB board they manufacture internally. So do you think this understanding is not correct? I mean, you can't consume whatever they manufacture internally?
There's a difference. For example, again, I'll clarify. For example, if I am making televisions, I'm just naming a product, not meaning what I'm making air conditioners, and I make 500,000, 1 lakh, 1 million air conditioners, then I can logically configure my plant so that I can have that board from my own production. But in our case, which is a well-diversified portfolio and not concentrated on one model or one vertical or one application, I don't see that situation arising. But yes, if I was to make 1 million televisions in a year, then logically I can put up a backward PCB plant to supply me 1 million PCBs. But still, it has to be evaluated on its parameters, whether it's giving me the returns or not. The value addition which I'm giving to a PCB manufacturer, which I retain in-house, has to justify the capex and the ROCE.
Got it, sir. Thank you, sir. Thank you.
Thank you. The next question comes from the line of CA Garvit Goyal from Invest Analytics Advisory. Please go ahead.
Hi, sir. I'm audible?
Yes, please.
Good morning, sir. Congrats for a decent set of numbers. My one question is on the product portfolio side, like the end industries. So our product portfolio is catering to various end industries, including also consumers and railways, and our industrial segment maybe including power and capital goods sector as well. So I just want to hear from you, like, based on your discussions happening with the ministries, like, is there any change in the government budgetary allocation expected for capex and growth in any of our end industries, sir?
See, end of the day, if I go to the utility metering, which is end user would essentially be government or these big private discoms which come up. And I personally don't see that on a sustained basis there should be any problem in that. Monthly, quarterly bits, some payments not coming to the guy, funding arrangements and all those things is part and parcel of the thing. But on a sustained basis, I don't think funding would be an issue. And again, this particular business is less than, if my memory serves me right, would be less than 20% of my industrial business. I think I should be doing about 200, 250 crores, 220 crores of utility metering electronics this year. And my our industrial will be about 1,000. About 1,000. So it's about 20-25%, which is directly related to funding from multilateral agencies of the government. The rest of the industrial business is purely with private sector. Now, you scratch even that private sector may be selling into data centers or private utilities or power supplies, power management units globally or within the country. I personally don't believe that funding should be a crunch for us on a sustained basis. Peaks and troughs will happen.
Understood, sir. That's it from my side, sir. All the best for the future.
Thank you.
Thank you. Ladies and gentlemen, we take the last question from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks. Sir, just want to clarify further on the possibility of QIP. So I guess we were contemplating entry in OSAT business. So just wanted to understand any update on that. And secondly, even if the company decides to go ahead with the QIP, will it be for the existing business or will it be largely for OSAT or third for any acquisition? Because the existing business seems to be doing fairly well. So I am not sure whether we require any funding in that business as such. So if you can clarify a bit more on that. Yeah, thanks.
We have taken our QIP approval just to be ready for any future growth. We have never contemplated
inorganic growth.
We have never contemplated QIP for our existing business related any kind of a working capital funding there. That's very clear. Regarding our OSAT plan, we have already communicated previously also, we are evaluating. We have been evaluating this business. And once we are clear in our strategy, yes, this business makes complete full sense in terms of overall profitability, business numbers and capital risk, then only we'll plan for it. But QIP anyway, whenever we at least plan, it will be much more for the growth opportunity, not for the existing businesses. The approvals were clearly taken only just to be ready for any future growth opportunity.
And just to add to what Gujralji and Vijay said, I think equity raising is the most costliest of funding. We are very clear on that only when such an opportunity does arise, which requires equity funding, we will raise it. We have enough accrual happening in the business itself to sustain continuous period of growth.
Yes. Yes.
So this is very helpful. Just lastly, understanding on the inorganic opportunities, whether we are looking at opportunities in India or internationally, and again, which segments we would be looking at the opportunities. Means in a way PCBA, or we would like to expand the services in overall EMS portfolio itself, or anything else.
Okay. You see, we have all the time been maintaining consistently for last several quarters that inorganic acquisition will not be made only for the sake of having a bump up in my EMS business. We would do an inorganic acquisition if it gives me access to technology, fills in gap in my product offering, gives me access to regulatory approvals. Then I would look at inorganic acquisition, because reinventing the wheel in such cases is a very long time consuming. Another thing I think where clarity will emerge in the coming months is Mr. Trump's policy on manufacturing in USA. I'm just sharing my thoughts aloud. Nothing on paper, nothing on plan, but that may necessitate Indian industries to have a near-shoring facility to the USA. It all depends upon what the plans and what are the policies which pan out in the coming quarters. Currently, we are evaluating what you call inorganic acquisitions, but there is nothing which has reached a stage where we can share it with the street or the analysts. There would be in areas of design, there would be in areas of defense and other things where we are not present today.
Okay, sure, sir. This is very helpful. Thank you.
Thank you. Ladies and gentlemen, that concludes our question and answer session. I now hand the conference over to Mr. Gujral for his closing comments.
Well, ladies and gentlemen, thank you very much, and for our insightful QA session. From the management side, I would like to assure each and every one of you that we are, as I've all the time been saying, focused on building an organization and an institution. Business is a byproduct. Business will happen. But a growth, sustainable growth in business has to be backed by tangible steps to create the organization, to which we are fully committed and we are doing. One of the steps is that instead of standalone units, we have started going on the campus routes to save on the cost. That's one of the long-term strategies of the government, of the company. We have commissioned or in the process of final commissioning of our facility in Germany. Germany currently is a bit of a spot, so I can't say today how fruitful that would be, but I'm sure in the long run it will be a big leg up to my export business. We are very, very mindful of our social responsibilities, diversity, and nurturing and retaining talent. Respect, mutual admiration, care of the employees and all the stakeholders is at the core of our philosophy. I'll just ask Sundar to share his thoughts on it for the final word.
Thank you, Gujralji. I think thank you everyone for good questions. Your questions are motivating us to think different and make sure that we are doing everything we can to satisfy all our stakeholders, which is, of course, the shareholders, customers, suppliers, as well as our employees and society at large. We are committed to a strategy. We're always talking about consistency, thinking long term. Yes, we are keeping very close eye on the quarterly results like we report every quarter to you. But on a long-term strategy, we are clearly focused on building this organization for future. And we are continuing to invest there. We are definitely encouraged with the progress we have made over last couple of quarters. And we expect to keep the momentum going. Thank you very much.
Thank you, gentlemen. Thank you very much, ladies and gentlemen.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.